The secret to building wealth on autopilot. How to double your money with these ETFs using DRIP Plus Rule of 72. What if I told you there's a way to build serious wealth without the stress of watching the stock market every single day or the gamble of trying to pick the next winning stock? That's what we're going to talk about today. We're diving into a powerful, proven investing strategy that thousands of people are using right now to grow their wealth. This isn't about getting rich quick. It's about a simple, repeatable system that lets your money work for you day and night, using dividend investing and the incredible power of compounding. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. The core strategy, simplicity meets power. The real secret to building wealth isn't complicated. It's built on a two-step strategy. Invest in high-quality exchange-traded funds, ETFs, that generate both income and long-term growth. Reinvest all your dividends and stay consistent. That's it. Seriously. This strategy hinges on two of the most powerful forces in finance, compound interest and time. And the best part? With today's technology, you can automate this entire process. Whether you're putting in $100 or $1,000 a month, the results over the long term can be truly life-changing. The foundation, your two secret weapons. Today, we're talking about a powerful strategy to accelerate your journey to financial freedom. It all comes down to two key concepts: the Rule of 72 and DRIP, or Dividend Reinvestment Plans. These aren't complicated ideas. The Rule of 72 is a simple mental model for understanding the power of compound interest. It's a way to quickly estimate the doubling time of your investments. DRIP is the engine that makes that compounding effect truly take off, turning your income into more income without you lifting a finger. Think of the Rule of 72 as your financial GPS. It shows you the path and how long the journey might take. DRIP, on the other hand, is the turbo boost button on your financial engine. It takes the fuel you're generating, your dividends, and automatically injects it back into your portfolio, creating a powerful feedback loop of wealth creation. Putting the Rule of 72 into action. Let's do some quick math to see how powerful this is. The formula is years to double equals 72/annual rate of return. It's that simple. Let's look at how this applies to the three ETFs we've discussed and see the real-world impact of consistent investing. For the high-yield income generator. If this ETF, with its high monthly yield, provides a total return of around 10% annually, we can estimate its doubling time. 72 divided by 10 is equal to 7.2 years. That means your initial investment could realistically double in about 7 years, fueled mostly by that consistent income stream. For the dividend growth powerhouse. With a historical total return of approximately 10.2% per year, this ETF provides a slightly different path. 72 divided by 10.2 is equal to 7.05 years. It's a similar timeline, but the investment strategy is different. It's all about a rising income stream from financially stable companies, a fantastic choice for a core retirement portfolio. For the All-American Growth Engine. This broad market ETF, with its focus on capital appreciation, has historically delivered an average return of around 12.1% per year. 72 divided by 12.1 is equal to 5.95 years. This shows how higher growth potential can lead to a faster doubling time. It's the fastest option on our list, making it a great choice for those with a long time horizon. As you can see, with returns in the 10 to 12% range, which have been historically achievable with these types of investments, doubling your money is not just a dream. It's a mathematical reality that you can plan for. The DRIP advantage, automation and acceleration. So, the rule of 72 gives you the timeline, but DRIP is what makes it all happen so efficiently. Without DRIP, your dividends would sit in a cash account, and you'd have to manually reinvest them. This is inefficient and, frankly, a hassle. By turning on DRIP, your broker automatically takes that cash and buys more shares for you. This is crucial for compounding. Each new share you buy starts paying you dividends, which in turn buys even more shares. It's a continuous, automated cycle that builds on itself. This is how you create a true passive income stream and see your wealth snowball. ETF breakdown: 3 paths to financial freedom. Let's look at 3 powerful ETFs that you could use to put this strategy into action. Each one offers a different approach, so you can pick the one that best fits your personal financial goals. Path 1. The high-yield income generator. This first option is a high-yield, covered call ETF that focuses on the NASDAQ 100. It invests in tech giants like Microsoft, Apple, and Nvidia, but with a twist. It uses a covered call strategy to generate a high monthly income stream. This isn't your average dividend ETF. It's a cash flow machine. It currently provides a very high annual dividend yield, paid out every single month. The true magic here is the monthly compounding. When you reinvest those monthly payouts, you're buying new shares 12 times a year, which dramatically accelerates your compound growth compared to an ETF that pays quarterly. Who it's for? Investors who want a steady, high monthly income stream and exposure to the tech sector. It's a great choice for creating passive income in any market condition. Path 2. The dividend growth powerhouse. This second option is a classic, blue-chip ETF that focuses on companies with a long, proven history of increasing their dividends every single year. These are the Procter & Gamble's, Johnson & Johnson's, and PepsiCo's of the world. Think of it as a portfolio of financial rock stars who consistently reward their investors. While its current dividend yield might seem modest, the secret here is that it's a growing yield. The income you receive tends to increase year after year as the underlying companies raise their payouts. This makes it a great choice for anyone focused on building a long-term, rising income stream. Who it's for? Long-term investors who prioritize stability and a steadily increasing income stream. It's perfect for a retirement portfolio because it allows you to sleep peacefully at night while your wealth grows. Path 3. The All-American Growth Engine. Our final ETF is a foundational holding in countless successful portfolios. It tracks the S&P 500, giving you broad exposure to the 500 largest companies in the U.S. If you want a simple, high-performance way to invest in American business, this is it. This ETF has a lower dividend yield than our other 2 options, but it makes up for it with higher capital appreciation potential. Over the last decade, this type of ETF has delivered impressive average annual returns, primarily driven by the growth of titans like Apple, Amazon, and Microsoft. Who it's for? Investors who want broad market diversification and are focused on total growth. If you had to pick just one ETF for a long-term strategy, this would be an excellent choice. Your 3-step action plan. So, how do you put this into action today? It's as simple as 3 steps. 1. Choose your ETFs. Decide which strategy best fits your goals. Do you want income, dividend growth, or broad market growth? Or better yet, create a balanced mix of all 3 for a well-rounded portfolio. 2. Automate your investments. Set up automatic monthly contributions from your bank account. Remove emotion from the equation and just keep adding to your positions. 3. Enable DRIP. Go into your brokerage account and turn on dividend reinvestment. It usually takes just a few clicks. Once it's active, your snowball is officially rolling. Final thoughts. The system that just works. Most people overcomplicate investing. They chase headlines and fads. But the wealthiest investors use systems. They build a solid foundation and let compound interest and time do the heavy lifting. This ETF strategy, powered by dividend reinvestment, is that system. It works for anyone at any stage of their financial journey. You can potentially double your money and then do it again in even less time because you'll be compounding on a larger base. This is how everyday investors achieve financial independence without the stress, drama, or sleepless nights. If you found this information helpful, please hit that like button, subscribe for more content, and let me know in the comments which of these ETFs you find most interesting. Disclaimer: this video is for equipping, educating, and empowering and should not be considered financial advice. Investing involves risk. Always consult with a qualified financial professional before making any investment decisions. Your financial well-being is paramount.